Hey, it's Michael Saul, but everybody calls me Tiny, so you can too. And this video is a simple ABC or something more complex. This is market analysis for the week of April 17th, 2017. So let's take a look at what happened last week in the market. Now, I'm using the SPY for the S&P 500, but you can use the cash market if you want. I personally like to do my analysis on ETFs. Whatever you want to do, that's fine. I get questions every now and then. Why do I use the SPY? To me, it's just, I don't know, I just like using the ETFs. Okay, so two closes below the 50-day moving average. First time that has happened since before the election. We broke this, I mean, it's not really a good trend line here because it kind of cuts through here. But if you start from here, even this little dip below it kind of voids that trend line. So let's try to delete that. That's actually not a trend line. I'm sorry. That was a Fibonacci retracement. That's why it was so weird looking. I only put it on. Gosh forbid I actually knew what it was. Okay. So if we take the trend line here and we go like this, and you got 1, 2, 3 tests, and then it broke down. So we do have a break below the trend line. Now, again, I do not believe that we are headed for a bear market here. But as I have been saying, week after week after week, I do believe that we will have a more complex correction than just a quick pause and go, quick pause and go. Okay, now, if it's just a simple ABC, A down, B up, and then the C wave equals the A wave, it would still be a lot more complex than we have seen since the election, since actually just a little bit before the election. All right, that would be complex enough. It would take several months to complete if the time is going to line up. This took almost a month, so that means that would take almost a month. That would be a few months or several months. Okay, and the measured move would be down here at 228.80, we'll call it. Okay, so what I like to use, rather than the number, I'm just looking at where this coincides with support. So it comes in right around this high back here in December, right around the December high, right around this little purple coil breakout here. All right, so that would be the measured move to the downside if this was to be just an ABC. But nothing's saying it has to be a simple ABC. All this here could be just the first wave down in a more complex corrective pattern. My personal opinion, and I'm saying it as I record this at almost 9:30 on Sunday, April 16th, I think we're going to give up the entire rally that started from the election. Okay, I'm saying it, so I can't say, well, I thought and this. No. Okay, that's it. I think we're going to give it all up. And the reason I think we're going to give it all up, I'm not a perma bear or anything like that. Let me run the fib grid that I had on already that I took off by accident. Okay, now ignore the 23.6. I don't really use 23.6 in my Fibonacci analysis. But if you use 38%, you come back to here. And if you use 50%, okay, and that is the rally from the January 2016 low to the March 2017 high, 50% of that would bring us below the election rally. Okay, so here's the last day, or close to the last day, right? This is actually, here you got, that's Friday, right? So this actually started Monday. This was the day before election day, but you got to count it because that's when it moved, okay? I think we give it all up, and it would still only be 50% of the bigger retracement. It would be around, 12 to 13% decline from the high. It's not even what most would consider bear market territory, but what I think happens is I think that we come down and I think we complete the ABC pattern. I think we get a little bounce. I think that fails. I think by then, wherever the 200-day moving average is, we test that. And I think if we break that, I think it's going to open some floodgates. Again, I don't think it's a bear market or anything like that, but I think it's going to bring in a little bit of panic. The 2 closes below the 50-day moving average. I mean, the 50-day was coming up pretty sharply. Is that enough to bring in panic? Probably not. But, I've been talking about how I think selling may go away. It doesn't have to be May 1st, but around that time zone, may even be starting early. Who knows? I think that's going to come into play this year because I think people are going to say, wow, we really got ahead of ourselves, and now we have to rest. I know people just think that, okay, President Trump is in office now, and everything is going to just go great. He's going to come through on all his campaign promises. And I'm not questioning that he doesn't want to come through with all his campaign promises, but he's not having that easy of a time getting things through. And just because, some people say, well, what was the health care? It's different. Well, it's all different. Everything is different. And he, not saying he's going to struggle with his other initiatives, but if he does, it's really going to hurt investor confidence. A lot of this rally was, hey, Trump's going to change things, and that's fine. It's how the market can rally on hope, right? Markets climb the wall of worry, but they also get a nice spike based on hope, okay? And, okay, Trump's going to change everything for business. It's going to be great. Everything's great, great, great. And, again, I'm not knocking him or his politics or anything like that. I'm just saying what the perception is. Then all of a sudden, we get way ahead of ourselves. We get very frothy, which I was talking about. That made me very nervous. And now we could be due for a correction, a pullback, whatever it is. I don't think it turns into the bear market, but I think at a minimum, we're going down for a C wave down here to, like I said, to basically, you could call it the December 2016 highs. But more, I think we're giving back the whole rally. Okay, I don't think the whole rally started from, not this whole rally, the whole rally started from the election. And again, it would only be about 50% of the bigger picture move. Okay, again, I don't think we get there right away. I think it could be a very arduous spring and summer. Is arduous the right word? I don't even know if that's a real word, but I think it could be one of those types of moves that take a while to go. I think it's going to frustrate a lot of swing traders unless you're looking at the short side. Again, I'm not saying that, okay, it's time to be all out bear here, but remember the market moves moves 3 ways, right? Sideways, up and down. So you could take advantage of it in all 3 directions, right? If it's going up, obviously you're buying pullbacks. If it's going down, you're looking to short rallies. And if it's going sideways, you're looking to sell premium on both sides, okay? So anyway, that's what I'm looking at for the market here in the short term. I think at a minimum, this ABC pattern gets completed, and maybe that's it, and then we just rally to new highs. Yeah, I don't think so. I think the 200-day moving average will be tested at a minimum, and I want to see what we do there. If that holds, then hey, look, it held beautifully right before the election. Nothing's saying that it can't hold. It's a much-watched moving average, even if it gets sliced through like this and then it quickly recovers. So definitely something to watch, okay? But my opinion is we're giving this whole thing back eventually. And I think we're going to do it this year. Okay, I'm not saying, I don't mean eventually, like, okay, in 10 years. No, I think this year we're going to give this all back. And it's not really that big of a move from here. What is it, 20 points at this point on the S&P? So what's that? That's less than 10% from here. All right, so again, I think it might take a little bit of time. Let's run through the other indices, look at some sectors. Here's the Dow, basically looks the same as the S&P. Here's the Russell. Okay, this could be a head and shoulders pattern. I'm reading it. Some people are calling it that. I like more symmetrical shoulders, but it's in the spirit of one, right? A higher high followed by a lower high and a rounding type of top there. All right, mid caps, look basically the same, and then the Nasdaq has been acting strong. It's still at the 50-day moving average, right? You can see the Russell below it, but the 50 days more sideways on the Russell. On the mid-caps, a little slanted, but more sideways. But the Q's pretty strong here, pretty nice strong push here. And slope is very important. The angle of the slope is very important on the moving averages. So see if that could close below there. Then we have support down here, 129.46. See if that gives way as well. Let's look at some sectors. Semiconductors, yeah, semiconductors are below the 50-day moving average. So they were acting really strong. and they got frothy and ahead of themselves. Here's Clad Tanker still looking okay. Here's Intel looking sloppy, not looking terrible, but looking sloppy. Is below the 50 and the 200-day, but is more in a big picture triangle. Here's NVIDIA now testing this key support right here. If this gives it up, watch for a test of that 200-day moving average. Let's go through the banks. Okay, the banks, yeah, the financials have been weak since topping out in March. They look like they could be in something in the spirit of a head and shoulders, not a real head and shoulders. Watch to see if this can get down to the 200-day moving average. It's Bank of America, Citigroup, JP Morgan. All right, let's look at the big tech stocks, and then we'll go to broker-dealer. Here's Alphabet. Amazon, looking okay. See what it does at the 20 EMA. That New York salute we talked about last week so far has been a stake in the ground. Here's Apple looking okay, but watch what happens if it loses that 50-day moving average. How about Netflix? Yeah, more sideways than anything. Here's the broker-dealer. Yeah, also moving lower. Here's Goldman, Morgan. Right now, there are no buy signals on these. Caterpillar, more sloppy. It's not a financial, just like I like to look at these like industrial type stocks. John Deere, okay, more sideways than anything, but stalled out before hitting a new high. So, I mean, this churn could lead to some softness. Watch where it broke out though, down at 104.30. Not a big mover, definitely something to watch. How about bonds? Okay, so bonds faked out the break to the downside, now breaking out to the upside. 200-day moving average is going to be the level to watch. It's also the high in November. Here's oil. Okay, so oil continues to rock and roll here. See how much further it can go. Usually oil peaks out around July 4th seasonally, so let's see what that does. And then gold. I was watching gold. I sent an email. Let's see it get over the 200-day moving average. Well, gold said, yeah, here we go, Tiny. We're above the 200-day moving average. So there we are. We're above the 200-day here in gold. Resistance. And I'm using the GLD. I like to use the ETFs and whatever, the spiders, whatever you want to call them. To me, I call them all ETFs, these types of instruments. 124.76. That's what you want to watch. It looks like it may make a beeline for that, but see what it does when it gets there. So, short term, I think the ABC gets completed. Again, a reminder, that comes in the 228s. I would like to reference the December high, 228.34, although it's a little bit past it, but whatever, it's fine. It's all in the same area. But I think that we're giving back the entire rally since the election. Okay, I don't think we're going to get there, boom, just like that. I think it could take some time, be an arduous, if that's the right word, spring/summer. Any questions? Tiny at attackthemarkets.com. Join the list at attackthemarkets.com and get updates during the week. Have a great trading week, and I will talk to you in next week's video.